I asked and you answered. In today's video, we're going over 8 stocks that we're performing snap judgments on. I have to give credit where it's due to Jeff and Andrew on the Focus Compounding podcast. They pioneered this format and I'm hoping it works just as well for us as it does for them. We'll cover the stocks that are most undervalued toward the end of the video, so stay tuned. Getting started with our first request, number 8, Visa. Visa is a stock we've covered on the channel before. It's a $506 billion giant that trades just $12 below its 52-week highs. Visa is the largest payment processor in the world and processes over $14 trillion of payments each year. It's capable of processing 65,000 transactions per second. That's insane. The company's a favorite among super investors, where there are 24 who own it right now. It's the 4th most owned super investor stock. There are 4 super investors, Chris Hone, Triple Frond Partners, Altarock, and John Armitage, who have double-digit percentages of their portfolio in Visa. Visa's a very high-quality company, yet still when we look at their valuations, it looks like they're slight ahead of these. Despite trading at lofty valuations, Visa actually pays a modest dividend yield that they've grown in each of the last 16 years. They couple this with a small amount of share buybacks, which gives them a reasonable 3.08% shareholder yield. That's not so bad, even as Visa is trading just 3% off its all-time highs. Analysts are looking for a $314.50 price target for Visa, which would say that the company has around a 13% upside. But when we run the numbers for Visa based on their fundamentals, it looks like a fair value is around $222 per share. Keep in mind there's a range around that number for their true fair value. Next at number 7, we have Twist Bioscience. This company actually makes up 2.36% of Cathie Wood's portfolio, which we covered when we did a deep dive into her stocks. Today, Twist Bioscience is a $1.85 billion company that trades just $1 below its 52-week high. Twist Bioscience is a biology engineering company. They pioneered a new form of DNA synthesis that uses semiconductor silicon-based wafers instead of traditional plastic plates. While all of that sounds very high-tech, it hasn't yet translated into profitability for the business. Right now, their value would really come from their assets, not their abilities to produce earnings or cash flows. This is really why outside of Cathie Wood, there aren't other super investors with holdings in the business. Twist Bioscience is still diluting shareholders by nearly 2% each year. Over time, that really adds up, especially as you're burning cash. Analysts have a stock price target of $42.50, which is just 1.5% down from their current stock price. When we look at the numbers for Twist, a fair value comes in around $18 per share, down significantly from their current stock price. Remember, this video isn't financial advice. It's not a buy or sell recommendation of any security. Use common sense and do what's right for you. Parsons Corporation is next on our list at number 6. It's a tech and engineering company that provides services to the US federal government and critical infrastructure segments. This was a private business until 2019 when it IPO'd. Since then, its shares have more than doubled. Today it trades just 6.76% off of its all-time highs. Currently, there are no super investors who own Parsons, but when it was first listed, both ValueAct Capital and Daniel Lowe bought shares of the company. They sold out by the end of 2019, however. Even as an established business, Parsons does not have a positive shareholder yield. They're still diluting shareholders by about 1% annually. Today, this is a business that trades for $11.3 billion and it's just $7 off of its all-time highs. Parsons looks stretched compared to its valuations and its abilities to produce free cash flows. This is why a fair value for the company comes in at right around $50 per share. Arista Networks is number 5 on our list. It's an $82 billion company that trades just $10 off of its 52-week and all-time highs. Since its listing just a decade ago, the company is up more than 23 times. They're doing incredibly well for shareholders. Arista is a networking company that primarily sells Ethernet switches and software to data centers. Some of the biggest tech companies in the world like Microsoft and Meta rely on its platforms as their largest customers. Even though they're a very high quality business that has very high quality and very large customers, it looks like Arista Networks is trading out way ahead of these valuations. Their stock price of $314 is very far ahead of this. Like some of the other companies we just looked at, they're also diluting shareholders by about 1.5% annually. Today, there are 2 super investors in the company, and that's Francois Rocone and Lee Ainsley, who both have just small positions. Rocone added to the business in the most recent quarter. Halfway there, Illumina is number 4 on our list. Illumina's been dealing with proxy battles by none other than the legendary rating investor Carl Icahn. He's issued 2 proxy contests in the last 2 years, although recently it sounds like he dropped his latest challenge. This comes as the company is down almost 80% off of its all-time highs after it had a huge busted $7.1 billion acquisition of the blood test manufacturer Grail. Illumina provides tools and services to analyze genetic material within life science and clinical lab applications. By far, most of its sales come from sequencing. Today, the company trades for just $20 billion per share, and I say just because it was over a $100 billion company at one point. Illumina is trading at half their 52-week high and just $20 above their 52-week lows. As the stock has dropped for the past few years, there are now a few different super investors who own positions in the company. Carl Icahns is the smallest, but he's the most vocal. This comes after he saw his position have a haircut and drop by more than 50%. As their stock has dropped, Illumina hasn't really been buying back shares. Instead, they've continued to dilute shareholders. Even though Illumina is down around 80% from its all-time highs that it hit just a few years ago, the company is still up more than 100 times and it's a 100-bagger from its all-time lows back in the early 2000s. The issue with Illumina, as we see here, is that they don't trade attractively to how they currently produce free cash flows or how these are expected in the future, but they are trading massively under the multiples that they were for in the past. This is typically what happens after a stock comes out of a bubble. This is why a fair value for Illumina looks to be around $91 per share today. That's pretty close to its 52-week lows, but it's still $20 below today's stock price. At number 3, we have a stock owned by 10 super investors that was a buy from Warren Buffett a few years ago, and in the most recent quarter, it was a 5% buy from Michael Burry. It's Citigroup. Citigroup right now is a $117 billion banking giant that trades at its 52-week highs. The company's been attractive as it's rebounded recently from its 52-week lows and has been pretty much up and to the right since then. Right now, it's also paying a good dividend yield of 3.34%, and it's buying back 1.7% of their shares. This adds up to more than a 5% shareholder yield, even at their 52-week highs. Still, Citigroup is a long ways off the nearly $600 per share that they were trading at prior to the global financial crisis. Since then, even as they've rebounded lately, they're still down around 90%. These standard valuations are going to look really wonky for Citi, as free cash flows aren't the right way to value a bank. Instead, banks should be looked at against their earnings. And on most of these earnings numbers, Citi actually looks pretty attractive still. Overall, it looks like Citi's fair value is pretty close to today's stock price, and we put that at around $65 per share. All the fair values for the video came from our Patreon resources. If you're interested to learn more, check that out, it's linked in the description below. The stock that's at number 2 on our list is Warner Bros. Discovery. This is a $19.5 billion market cap that trades just 70 cents above its 52-week lows. With this, it's almost been cut in half from its 52-week highs. Warner Bros. Discovery is owned by 7 super investors, and this is led by Seth Klarman, who we also looked at in a very recent video. Interestingly, Michael Burry recently added to this company as well. He started a 4.5% position in his portfolio in the most recent quarter. This is the second time Burry's bought Warner Bros. After his first purchase, the stock has continued to trade lower. As for Klarman, he's bought shares twice and he's owned stock for around 2 years. Warner Bros. Discovery was formed in 2022 through the combination of Warner Media and Discovery Communications. Today, it owns an extensive collection of TV assets, cable networks, the HBO brand, and Max streaming services, as well as an extensive collection of IP. David Zaslav is the company's CEO, and he's a top lieutenant from John Malone. Warner Bros. Discovery is set up like a classic John Malone company. It has tons of long-dated debt, and right now the company looks very poor compared to its tangible book or asset value, but it looks pretty attractive compared to its abilities to produce free cash flows. The key with this one, as with any Malone company, is making sure that these cash flows are able to support their debt loads. Following their merger, their stock briefly spiked before it's only traded lower in the last couple of years. Back in 2021, there was a short squeeze with Discovery stock that sent their shares soaring. At one point, they were priced at more than $80 per share, so it's down around 90% since then. A fair value for Warner Bros. Today comes in at around $14 per share, so it looks like there's a pretty decent amount of upside in this one, and that's actually pretty close to the price that Seth Klarman was originally buying into the company at. Speaking of Klarman, the company that tops our list at number 1 is Viasat. It's a longtime Klarman holding. Today, this satellite and telecoms business is a $2.1 billion market cap that trades just $2 above its 52-week lows. they've been cut dramatically from their 52-week highs, falling by more than half. Klarman's the only super investor in this one, and he has a $452 million position that makes up just under 10% of his US listed portfolio. This has been a long time holding for Klarman, as he first established a position back during the global financial crisis. At one point, it made up an entire quarter of his portfolio. In the last 10 years of Klarman owning this business, its stock price is down nearly 73% overall. That's not good. The business looks like it trades attractively compared to where it has in the past, but it looks very poor on an asset basis, and that's pretty much what's going to give it its value here. Still, because of those assets and how the accounting is done for the business, which means that they may not be properly reflected in their book value, it looks like a fair value is around $22 per share. That's about where Klarman first bought into the business, and it's a little under where he's been recently selling. Thanks for submitting these stocks for analysis. Be sure to share your thoughts in the comments. If you enjoyed the video, like it, and if you're interested in more, subscribe to the channel and watch this next video.